Welcome to All That Matters, episode 4. This is a conversation show about markets, investing, and wealth management. My name is Ross Mayfield. I'm an investment strategy analyst at Baird, and I'm thrilled to be joined by my friend and colleague, Mike Antonelli, a market strategist at the firm. Mike, how are you doing today?
It's summertime, mid-July. I'm feeling pretty good. It's sunny out right now. The vibes seem better in the stock market and the economy to me, Ross. I think things have definitely shifted to a different tone. What do you think?
Yeah, I agree. No obvious boogeymen out there. We got past the debt ceiling. The banking crisis has kind of faded into the background. It's definitely hot. That's my personal boogeyman right now, is like 100
Yeah.
degree days, but I'll take it, all things considered. So, with that kind of slow and steady summer doldrums in mind, I thought today we could do, a couple of things that surprised us about the market, or maybe even shocked us a little bit about the market. Ultimately, things that matter and are important that are maybe being undercovered. If that's good with you, Mike, I'm just gonna hand the football over to you and get your first one because I think it's pretty good.
Yeah, this will be fun. Ross and I are constantly in search of things to talk about, things to engage with our customers about. So, Ross, I ran across this the other day, just kind of looking at the long-term returns of the stock market. I always think about that when I'm talking to clients or when I'm thinking about planning. So, the long-term return of the stock market, if like the past 100 years, the nominal, so not inflation adjusted, the nominal return of the stock market's about 10% per year. That's the nominal long-term return. So, how are we doing this decade? And what a decade we've had so far, Ross. 2020, what a decade. We're 3.5 years in. What is the stock market's return, the S&P 500s, over this first 3.5 years? I looked it up. It's a little over 11%, Ross. 11. So actually, in this crazy decade, the stock market's actually a little bit above the long-term averages. Does that surprise you?
It does surprise me, and I do this every day too. I'm in it for a living, so it probably shouldn't surprise me. But two bear markets, two kind of world-changing events as far as the pandemic and then inflation. And like you said, here we are above double digits, above the long-term average. And if there's one takeaway for me, it's just that this is what average or above average looks like. It's volatile, it's messy, it's not a clean line up and to the right, and yet we kind of end up here over the long term anyway. So I'll take it for sure because it's been a volatile decade, and I think anybody would be thrilled to have that return.
Right. The long-term average is composed of a bunch of short terms, and the short terms get crazy. Just to wrap up kind of my take, I looked at a 50-50 portfolio too, to be fair, because we have a lot of wealth management clients that we deal with. How is a 50-50, right? 50% stocks, 50% bonds. That's doing about 5% this decade so far. That's long-term return is about 7%. So we're below that, mostly because interest rates were zero during COVID. We had that really low interest rate regime. But just to be fair to 50-50 versus all stocks, and these might not match your returns, but it just surprised me that with the stock market's actually doing better this decade. So Ross, what's on your mind? What surprised you?
Yeah, so shifting from the market to the economy, I want to talk about the labor market a little bit. I think at this point, everyone knows that we have a pretty hot labor market, a pretty tight labor market. But one thing that might be surprising is, over the last year and a half of doing client events and talking to people, the major topic has been, where are the workers? We have this labor shortage. Where are the workers? And today, in the summer of 2023, we are doing a better job of employing people and getting people to work than we've done in a long time. So the employment to population ratio for prime age workers, 25 to 54, is at its highest of the cycle, and it's at its highest of the last 20 years. So that's just an incredible signpost that we're getting the people who most want to work, early and mid-career folks, into jobs at as good a rate as we've done in 20 plus years. And really, outside of one little period, as good a rate as we've ever done. So it's even better for the female population. I'm really impressed that we're getting people who want to work to work. It's not perfect, but at a rate about as good as we've ever done in this country.
This is a great stat. I love a stat. I actually used this in a client event in Kentucky just a couple of weeks ago. So if you took our prime age population, 25 to, 54, right? And said, what percentage of those are working? That peaked in the year 2000 at about, I think it was 81, Ross, like a little bit above 81%. We're at like 80.9. So the United States' economy our prime age people are working. Women, it's the highest ever. So these are great stats. People do want to work. They are working. The composition of labor changed, Ross. People left some jobs to go take professional and technical jobs post-COVID. So the U.S. labor market is really, really strong, Ross. And this is great. I really love this take.
Yeah, it's right. It's a consumer-based economy is driven by how strong a labor market is. The labor market is strong. Wage growth is good, but not so good that it's inflationary and problematic, in my opinion. And it's a really bullish signpost for me that we're able to get people in jobs that want them. All right, Mike, Number three, what you got?
This gets talked about a lot. This one, I see it talked about a lot. It's on people's minds. Certainly, this is a component of inflation. We're going to talk about crude oil production. The United States, largest crude oil producer in the world. Are we still? What happened? So I looked into the data. I went on EIA's website. That's the government agency that kind of tracks crude oil production. And I looked at what was our peak. So I looked it up. Our peak was about 12.9 million barrels of crude oil per day back in December of 2019. It dropped to 9.7 million during COVID. Where are we now? This really surprised me, Ross. Where are we now? 12.6 million. 12.6. Ross, we're almost back to the most barrels of crude oil we've ever produced in a month. COVID, remember, we broke the world. COVID really did set back a lot of things, break supply chains, cause inflation to surge. We're repairing this, Ross. We're almost back to where we were. I love this stat.
Yeah, I think it's great. I mean, two things, and you hit on both of them a little bit. So number one, for a consumer, more supply of oil on the market means lower gas prices. And that's really important for how the consumer views the world. Gas prices are like one of the number one things that drive how we feel about inflation and the economy. And if gas prices are in check, consumers happy. And then on the more geopolitical side, I mean, if we're producing enough energy, to run our country, it makes us energy independent, or at least gets us close, makes us less reliant on nations that we might butt heads against at some point. And ultimately, it's just great for the kind of security of our nation as a whole. I think it's really bullish on the economy writ large. So I'm glad you brought it up.
Yeah, I love it. Again, oil, jobs, these are things people kick around, but they never really look like at what's actually happening, which is why I love that we're doing this. Let's just go look at what's happening. Is that surprising us? And frankly, it is. So Ross, what's your next one?
Yeah, so from the economy back to the markets, I wanted to look at what happens after you have a really first strong half to the year, because I think a lot of people would be inclined to think, well, we pulled all the gains forward, so the second half has to be bad. Maybe I should take some gains. But historically, if you look at roughly the last 100 years of market data, if your first half return is over 10%, which we did in 2023, your median return for the second half is above the long-term median. It's better than expected at like 11% roughly. So this idea that the market has to take a break, maybe it does in the really near term. We're entering kind of a seasonally tough patch. But over the full second half, it's a bullish signpost. It's momentum in the market. It's resilience in the market. And all of those things are bullish, not bearish. Mike, you've been investing longer than me. What do you think about that idea of momentum in the market?
I mean, I love this stat because people always think if things are going well, they have to go bad. That's not generally how the stock market works. The stock market tends to work on something more akin to, are things getting better? Are things getting worse? Or are things staying the same? Our friend Charlie Bolello, he's a finance content producer on Twitter. He's great. He looked at the top 15 starts to the year through the first 132 trading days, which is where we are roughly right now. We're at number 13. It's the 13th best start to a year through the first 132 trading days. He looked at the returns the rest of the year. There's only one outlier that's really bad, and it was 1987 because there was a crash. But if you looked at the full calendar year returns, there's no negative ones on there. And it just, past performance, no guarantee of future results. Ross and I are just giving you the data here. This is just evidence-based investing. But Ross, what's your take? Are things getting better? Are they getting worse? Are they staying the same? I think they're getting better.
I mean, I think they're getting better too. A lot of the stuff we're talking about is reflective of an economy that has been surprising to the upside for most of this year. I mean, we entered the year and a lot of the outlooks were negative, expecting recession, expecting, the market to if not crash again, at least struggle. And things have been better than expected, and it's pushed the market higher. And we're seeing some of that momentum start to pick up. Sure, you have, an AI surprise that kind of helps out, but a lot of it's rooted in just the basic economy is stronger than expected and improving, kind of every day. So that's a really good point. And I'm glad you brought it up. And kind of along those lines, let's finish, with something that is really important and really, I know, near and dear to your heart with number 5.
Yeah. So the last one I want to talk about is just, I mentioned vibes. The vibes just seem better so far in the summer. And that's an important term almost in a macroeconomic sense. Are people comfortable with the value of their home? Do they have a job? Are they spending? These are the things that actually drive the economy and the stock market. You may not know this, but there's an artist out there touring across the country. Her name's Taylor Swift. Ross, she's going from city to city and basically bringing economic stimulus to major American cities. She goes to a city like Pittsburgh or Cincinnati or Chicago, And she brings 3 nights of basically BCS bowl games. She's selling out hotels. You sell out restaurants. You bring economic activity across the country. And now she's not the reason why things are, why the stock market's going up and things are doing better, but she's part of it, which is the vibes are getting better. People are out spending money. We're out of this post-pandemic, out of this COVID mindset. And is she one of the reasons? Ross, a Fed governors were talking about her. Did you see that?
Yeah, the Federal Reserve, kind of in our minds, some of the stuffiest economists there are. They wear their suits and ties, and they're talking about Taylor Swift. They have to talk about Taylor Swift because you're right. It's like cutting a stimulus check to every city that she goes to. But you're right. It's more emblematic of the broader scene, right? You go to, I went to Disney World a few months ago with my family, and it's the same thing. It's packed to the brim. You go to airports, they're packed to the brim, and the prices are a little bit higher. I mean, that's true, and it's inflationary, and people feel that, but they're also still spending, and so it means more dollars are in the economy. I mean, this post-COVID services boom, we're out of the house, we're out of lockdown, is still going on at the same time that the cost side, the supply chains are all normalizing. So it's kind of, the best of both worlds in a sense. And you can really feel it. And you're right. It's starting to be reflected in the vibes. Just last week, consumer sentiment, a major survey hit a 2-year high. People are finally starting to cheer up a little bit.
A couple things can be true, Ross. There can be parts of the economy that are struggling. There can be parts of the economy that are doing well. There can be consumers that are struggling and consumers doing well. Essentially, we're looking at kind of the aggregate. In the aggregate, the economy seems to be avoiding this recession that's been called for, seems to be avoiding it because of just the average ordinary person has a job, they're spending money, their home price is stable. So Ross, take us out.
No, really good point to end on, because we do talk about these things at such a high level that I don't ever want it to get lost that some people are doing better than others, or some areas are doing better than others. It's a really great point to make, and I think super important. But hopefully this was informative, a little entertaining. It is those kind of summer doldrums. So hopefully some things you didn't know about, some things that kind of perk you up a little bit. And Mike, thanks for the time. Anybody watching, thanks for the time. And we'll be back next month with another episode.